Hello everyone, welcome to my YouTube channel. This is Srinivas. Today's topic is compounding and rebalancing portfolio while backtesting. So in my earlier backtests, I found some issue while calculating the compounded returns, that is CAGR value. I observed that some of the trades are taking more than a year to hit stop loss or target. In the current method, what I'm doing is whenever a trade is exited, I'm considering the profit or loss resulted from the trade in the exited year only. Ideally, the trade has spanned over multiple years. In reality, I have to calculate the trade returns individually for each year and consider that returns in each year differently instead of considering the single year wherever the trade is exited. So, what are the method I'm using currently is not a correct method. That will create some differences here and there. It won't be an accurate returns value, CAGR, or it may be drawdown value as well. To fix that issue, I have come up with some approach and I have coded the same thing in my backtesting project. Who can use this method? So primarily this is very useful in backtesting to calculate accurate returns and accurate drawdown value. Other than backtesting, any swing traders or investors or anyone who want to compound their portfolio and also rebalance their portfolio in a systematic way, so this method can be useful. So let's see how to calculate CAGR accurately. So using this method, if a trade is spanning over multiple years, then we need to split the trade into multiple sub trades, one sub trade for each year. So that means, for example, a trade is initiated in 2010 and exited in 2012, right? So by the end of the year 2010, we have to close the trade and we have to create another trade. That trade will span till 2011 end. We have to close that second trade in 2011 end and create another trade. And in 2012, somewhere in between, we exit the trade. So ultimately, a single trade converted into 3 sub trades. In each year, like 2010, 2011, 2012, we have to calculate the trade returns individually so that each year will have a proper returns for that particular trade, so that it will result into proper CAGR calculation, and even that is useful while calculating the drawdown as well. So in simple terms, what we can do to achieve this, at the end of the year, ideally on the last trading day of the year, we just sell the entire portfolio of all trades and convert them into cash component. Okay, and this cash component, whatever we have, will be the starting capital for the next year. We need to continue the same trades, right? So we just buy the same stocks again, thus creating new trades on the same day from the cash component by rebalancing the portfolio. Of course, rebalancing is optional here, but to calculate appropriate CAGR values, we just assume that selling entire portfolio at the end of the year and buying it again. Yes, let's discuss about the compounding method. So assume that there is initial capital of 10 lakh and our portfolio having maximum of 10 stocks at any given point of time. That means your portfolio can have 0 to 10 trades at any point of time. The capital for each trade would be 10 lakh by 10. We equally distribute the capital among all the trades. That will be 1 lakh for each trade. And while compounding, we take 2 portfolios into consideration for easy calculation. That is one cash component and one is say stocks or trades portfolio. Okay. So let's understand this with an example. Yes. On January 1st, 2010, assume you are going to buy 10 stocks in your portfolio. Okay. So if you look at this table, initially you have the cash component of 10 lakh, right? And as you buy some S1 stock with 1 lakh value, and the portfolio of stocks will become 1 lakh and cash component will become 9 lakhs. Then you bought some other stock with same 1 lakh, the cash component will become 8 lakhs. Similarly, just keep on buying all the 10 stocks and the cash component will become 0, right? And over the period of time, the portfolio of stocks will keep growing or reducing depending on the market fluctuations. Now we have the cash component of 0. Okay. Assume after 2 months on March 1st, there's a signal came for 3 stocks S4, S7 and S10. Assume S4 and S10 got stop loss hit and S7 got target hit. So when we exit S4 with 8% loss, the resultant value after selling stock will be 92,000. Okay, we lost 8,000 here. And we'll add this 92,000 to our cash component. Earlier we have the cash component 0. Now the cash component has become 92,000. Then we exit S7 stock with a 30% profit. The resultant sale value is 1,30,000. We'll add this to the current cash component, which is 92,000 plus 1,30,000, resulting into 2,22,000. Then we sell one more stock S10 at 5% loss, and the sale consideration value from S10 stock is 95,000, which we're adding to the current cash component of 2.2 lakh. Then the resultant value becomes 3,17,000. So now we have the cash component of 3,17,000, and the number of stocks in our portfolio has now become 7. Initially we had 10, we exited 3 stocks. Now the portfolio having 7 stocks with the cash component of 3,17,000. Here we don't need to worry about the portfolio value of the stocks. We just need to worry about only the cash component. Okay. And after 1 month, on April 1st, 2010, we are buying S11's new stock into our portfolio. And at this point of time, we need to decide how much capital we need to invest into this particular S11 stock. Okay. How to calculate it? It is based on this formula. Look at here. So the new trade investment value will be current cash component value divided by the 10 minus number of current trades. So in this case, we have 7 trades in our portfolio. So that will become 10 minus 7, 3. Okay. The denominator will be 3 and the numerator will be the cash component value. The cash component we are having is 3,70,000 divided by the 3, which will result into 1,05,000. So 1,05,000 we are going to invest in stock S11, and our cash component will become 3,17,000 minus 1,05,000, which is 2,12,000. Okay. And further, on May 1st, assume we are going to buy another stock S12. So this time again we have to apply the same formula. The cash component, that is 2,12,000 divided by 10 minus number of current trades. Now we have 8 trades, right? So 2,12,000 divided by 10 minus 8, which is 2,12,000 divided by 2, that is 1,06,000. So we are going to invest 1,06,000 into stock S12, and we are left with 1,06,000 cash. So just continue this process. So that means whenever a new stock is added, so the cash component will be reduced, that will be added to the stocks portfolio. And when a stock is exited from the current portfolio, what are the sale value we get by selling the stock, we'll add that sale value to the current cash component. And when you take a new trade in the future, the new trade value will be calculated based on the current cash component value and the number of stocks you will be buying into your portfolio. Now let's try to understand the rebalancing method. Generally we do the rebalancing only at the end of the year, that is on December 31st, or which was the last trading day of the year. Let's take for example at the end of any year, we have a portfolio of 7 stocks. Okay, of course our complete portfolio is of 10 stocks, but assume that we have only 7 stocks at that point of time, and as per this quantity, and the current market price of each stock is like this. Okay, and the current value, that means at the end of the year the value of each stock as follows, like 1,22,000, 1,69,000, 85,000, 187. Like the total value of all these 7 stocks in portfolio is 10,83,150. And at this point, assume we have the cash component of 4,30,000 extra. The total will become 15,13,150. This is outstanding capital at the end of this year. Now we have to rebalance our portfolio. So why rebalance is needed? We need to make sure each stock in our portfolio will have the same invested value at the end of the year. That's why rebalancing is needed. Here the value of stocks are different, right? So we have to make sure we make equal value for each stock. Let's do rebalancing. Now, yes, the same stocks, again the current market price value is not going to change. Okay, assume we have sold all the stocks in the previous step, and we got 10,83,150, and we added this to 4,30,000 cash component. Our net cash component is 15,13,150. Now we have to buy the same stocks again, but this time with a different quantity after applying the rebalancing. So when you have 15,13,150 outstanding cash, we have 10 stocks max in our portfolio. We have to divide this number by 10. So each stock will be having 1,51,315. Okay, depending on that, let's apply here. So how it look like? See, so we need to buy 148 quantity of S1 and 623 quantity of S2, and look at the value. So more or less same value for each stocks after rebalancing. Earlier we had, let's say, S1 120 quantity, now it's 148. And in case of S2, 700 quantity becomes 623, sorry. S3, 400 quantity earlier, now 712 quantity. Okay. Earlier it has value of 85,000, now it has value of 1,51,000 after rebalancing. So this way, we rebalance the portfolio to make sure each stocks in our portfolio having the same value at the end of the year. And what are the cash component we have? Out of 15,13,150, when you deduct this amount, the cash component will be 4,57,118. And when you have a new stocks to buy as per your strategy, we'll be calculating based on the cash component value. For example, we will be adding 3 more stocks to our portfolio, right? Let's say S8 comes into buy mode. At that time we have to buy. So we need to calculate how much money you are going to invest into that particular S8 stock. And cash component of 4,57,000 divided by 3. So what is the amount you will get? You are going to invest that much amount into the stock S8. So this is how the compounding and rebalancing method works. I am going to use this method in my next all backtest reports so that a proper CAGR and a proper drawdown value can be calculated. Okay. Thanks for watching.